Here with our trades is Courtney Garcia, Senior Wealth Advisor at Payne Capital Management and a CNBC contributor. Welcome, Courtney. Let's start with we're starting with Cisco. They are in the news again because they unveiled a cybersecurity offering to protect against AI cyber threats. The shares are trading at 3-year highs. They have some exciting partnerships with these AI startups. Courtney, what do you do with it here?
Yeah, and I kind of heard you guys introing this of are these old tech stocks like the new future? And I do kind of like that idea of going with some of these older tech companies. I think there's a lot of longer term growth opportunities here. And this is a company that has a really strong balance sheet, right? They have over $5 billion in share repurchases still authorized for 2025. They recently increased their dividend to 3%. And you're likely going to see more M&A activity from a company like this, and having that strong balance sheet and likely going to continue to return that value to shareholders. So I do think short term, I don't know what the catalyst is going to be to bring some more robust growth for them. But longer term, I think a lot of these are really positive opportunities here and something you absolutely want to make sure that you have for the longer term.
All right, stock number 2, Courtney's GE Aerospace. They had good earnings. They got a big buyback. The stock is up nearly 7%. But what do we do with GE Aerospace?
Yeah, and this is a company that beat expectations on top of a really high bar being set, right? I mean, this was up almost 80% over the last year coming into this. And they really beat expectations and really set a good guide for what their outlook looks like for 2025. And this is a story where the demand is clearly there, where you're looking at aging fleets for when it looks at aircrafts, or you're looking at expanding aircrafts. Commercial airlines are expected to basically double by 2042, and they service about 75% of U.S. commercial airlines. So the demand is there. It's more of a supply constraint, and they've really been working with their key suppliers to make sure that they can address that. This is going to continue to be a positive for them as we look to this year. So again, a company with a very strong balance sheet, really returning a lot to their shareholders. I think they still have a lot of upside here, despite the fact they've already done very well.
Well, one moving to the downside is Electronic Arts. They just slashed full-year guidance for bookings. They cited a slowdown for the soccer game franchise, and the shares, Courtney, are down 17%. Do you pick them up here?
Yeah, and this one is tough, right? I mean, coming into this is a company that has a lot of sports franchises, which are annually released. So that adds a lot of more recurring revenue that can be reliable when you're looking at a company like this. But then you get news like today where in their soccer franchises, you see this big kind of unexpected drop off in demand. So if that really is something structurally changing for them, that would be an issue because it's a really high margin business for them. I think the question you have to ask is this something that's more seasonal or execution related, in which case it's more of like a one-time thing? And is this sell-off justified, right? It's down over 17% on this. So I would actually be inclined, it might be worth picking some of this up as an opportunity. But I would actually proceed with a little caution until you get to that earnings call. I believe it's February 4th, where you really get some clarity of why this happened and kind of what they expect that to look like going forward.
I remember playing those soccer video games like literally 20 years ago. So I'm sure a lot's changed. Franchise with some staying power. Courtney, thanks very much. Appreciate it.